This is Bloomberg Daybreak Middle East and Africa. Our top stories this morning. Asian stocks rally after Fed Chair Jerome Powell says the data hasn't given the FOMC confidence that rate cuts are appropriate, but he also downplayed the prospect of rate hikes.
I do think it's clear that that policy is restrictive. I think it's unlikely that the next policy rate move will be a hike.
Apple results later are expected to attribute declining sales to weak China demand. The Vision Pro also in focus. Plus, we speak exclusively to the CEO of Qatari telecoms group Ooredoo after first quarter earnings beat. It's just gone 8 a.m. across the Emirates. I'm Vonnie Quinn in Dubai, and let's see how we're shaping up after a wild ride in yesterday's U.S. session. We saw stocks gain after the Fed chair's remarks, only to lose all of those declines, and for the S&P 500 to drop 0.3%, the Nasdaq 100 down 0.7%. Today, it looks like we're in for a rally at the open, at least according to futures right now. To cut or not to hike, that's what JP Morgan says is the question right now for the Fed chair, and that's what he put out there, Diane Swank, saying it was a slightly more hawkish tone to the statement, but there will be a lot of parsing of this and also of economic data. We get jobs on course on Friday, and we also have to digest the JOLTS number, which was a little bit weaker than anticipated, even as we are still seeing inflationary pressures in those data. The two-year yield right back down to 494.97, so about a 5 to 7 basis point move there. And we are continuing to see the air come out of a barrel of crude oil. We actually have WTI below $80 a barrel now. And then take a look at this chart real quick, because it does show us the SOX index. It's been having a difficult time. If we can interpret that might make it more difficult for the S&P 500 to continue to rally, well, then it's possible that the SOX's gap lower may mean that the S&P will follow, but I'll leave that interpretation up to the professionals. Let's check in now on those markets in Asia. They are rallying, but there's also a lot going on currency-wise. Avril Hong is in our Singapore studio.
Actually, it's a bit of a mixed bag in this part of the world, Vonnie. We're seeing the stock benchmark in Japan and South Korea moving sideways. A lot of it got to do with the Fed and how, even though the imminent move might not be one of a hike, it's not like we're going to get a cut soon. And we are seeing, to your point about the rally, the Hang Seng moving on up, poised for an 8th session of gains. This would be the longest winning streak since 2018. And a lot of bottom fishing has been going on, as you know, Vonnie. And today we're also seeing Chinese tech stocks rising, that rally coming underway, thanks perhaps to some optimism about the earnings season ahead for some of these Chinese tech names. Let's take a look at dollar yen, because there was a sharp move from roughly 157 to 153. Flip the board if we can. And that bore the hallmarks of intervention, but then weakening back up towards the 156 level now. And, you know, you get the sense that the yen bears are back. They're going to continue testing the market to see how far Japanese officials are going to go in defense of the currency. But they do have the fundamentals, the yield gap on their side, especially after what we got from the FOMC. Vonnie.
Avril Hong in Singapore, thank you so much. Well, Fed Chair Jerome Powell then keeping hopes alive for a rate cut this year. But he also says a burst of inflation has reduced confidence that price pressures are ebbing.
In recent months, inflation has shown a lack of further progress toward our 2% objective, and we remain highly attentive to inflation risks. It is likely that gaining such greater confidence will take longer than previously expected. I think it's unlikely that the next policy rate move will be a hike. I do think it's clear that that policy is restrictive, and we believe over time it will be sufficiently restrictive. I don't know how long it'll take. I can just say that when we get that confidence, then rate cuts will be in scope. See if anybody mentions in any way the pending election. It just isn't part of our thinking. It's not what we're hired to do. We just don't go down that road. If you go down that road, where do you stop?
Let's bring in Bloomberg's MLive strategist Mark Cranfield now. Mark, why is the Fed chair so confident that this current boost in inflation will go away by the end of the year?
Well, it's part of their considered projections. They do a lot of research on where inflation is going. They spend a lot of time on it. So they will have masses of data, and they still feel fairly confident it's heading in the right direction and will achieve their targets. Maybe taking a little bit longer than they originally thought, but they won't give up considering how much time they spend considering it. But at least he threw out some hope to markets there, although he can't promise interest rate cuts as quickly as maybe people had expected just a few weeks ago. He did at least offer something positive in terms of the quantitative tightening by reducing that coming up in June, and by quite a substantial amount. It's been dropped from 60 to 25 billion. That takes quite a lot of pressure off the Treasury market, which in turn is a positive for the equity market. It obviously hasn't shown up a great deal yet, but as people get a chance to digest it, and probably after the non-farm payrolls numbers, which come up at the end of the week. Once we get past that and a few more earnings as well, people will probably realize that the Fed did as much as they can given the circumstances. So all in all, it certainly was nothing like the hawkish outlook that many people expected. In fact, it was a slightly positive stance from the Federal Reserve.
Mark, thank you so much for the context there. That is Bloomberg's MLive strategist, Mark Cranfield. Let's continue this conversation now with Ryan Lamond, Chief Executive Officer and co-founder of Neovision Wealth Management. So, Ryan, would you agree that, as Mark says, we'll continue to see the data, but perhaps everything is going to be okay and the markets will get a cut by the end of the year?
Well, Vonnie, yesterday was very confusing with Mr. Powell, because saying that they are data dependent and then acting not so much as data dependent is very confusing. Yesterday, let's invent a new word, hawkish dovishness or dovish hawkishness, I don't know. What I think the Fed is in today is in limbo. It's too early to cut rates and it's too late to hike rates. This is exactly where the Fed is. It's quite confusing.
They didn't sound so confused, though. The Fed chair seemed very confident that they are on the right path, that inflation is coming down, that this might be a temporary blip in ECI or what have you, but that everything is under control.
Well, this is the message he conveyed, and I agree with you, a lot of confidence, but this has reflected relatively poorly on markets. Markets jumped immediately above 1%, and then they closed mostly in the red at the end. So when you look at the numbers, look at the ISM prices paid. It's at 60, the highest since June 2022. If you look at ISM new orders, it's below 50, contractionary. Look at ISM employment, it's below 50, it's contractionary. Look at core, super core, it's going up. Inflation seems to be coming back. We are heading to a potential stagflation scenario. I agree with Jamie Dimon when he said there's more than 50% chance of stagflation. I agree with that.
The Fed chair said that monetary policy is restrictive and that it's restrictive enough now, that it's sufficiently restrictive. You're shaking your head. Why not?
Absolutely not restrictive. Look at financial conditions. They're very, very easy. Look at financial markets. Look at stock markets. Financial conditions are very easy. Add to that, 2 days ago, Mrs. Yellen announced that there will be treasury buybacks. This is expansionary. Look at fiscal spending. Finally, they were tapering the QT from 60 billion a month to 25 billion a month. This is huge. This is massive. This is very much expansionary. This is not restrictive at all.
I know that you have the feeling that the election will have something to do with it, but Fed Chair Jay Powell very specifically said, and he almost got annoyed, the election is not going to interfere with what we do. We are completely independent, apolitical. We have nothing to do with the election. We will hike in whatever month we want to hike.
He has to say that.
Or cut.
He's a professional. He has to say that. All around the world, US, Europe, China, Japan, everywhere in the world, there is political intervention with fiscal and monetary policies. This is unavoidable because these answer to the political leaders of the country. So there is influence in a way or another. We've seen this with Mr. Trump, and today we're seeing it in a much more subtle way.
I want to ask you a little bit about China, because we are seeing HS Tech rally substantially today and over the last few sessions. And I was just looking, we're up about 20% since the beginning of the year. That in the past, or at least in the last couple of years, has tended to be relatively short-lived. So macro tourism is a word Julie Wren, our columnist, uses for it. Is this sustainable?
We were very nervous about China late 2023, then decided early 2024 to come in again. And when we met 1 month ago, this is when we really started going in full on. HSI Hang Seng was at 16,600. Today it's 18,155. So that's a very nice jump since. What we're doing is we're booking profits, resetting positions, So we're doing it in a very gradual way to avoid, as you rightly mentioned, a turnaround of China, Chinese equities. But we do think this could be sustainable. Growth has surprised to the upside. Manufacturing is coming back quite clearly. What we're worried about is Europe, US tariffs and imports from China, though we think US and Europe, they need China because they need to import deflation. They need to reduce inflation by importing deflation from China, lower manufacturing costs.
So when you say you're resetting positions, are you changing industries in China, or are you moving, to different types of asset classes?
So we're booking profits quite regularly. Every time there's a jump, a nice jump, we book profits and then we reset positions. And absolutely, we're doing a lot of stock picking, a lot of very detailed work in picking the right companies, the right industries. Try to go into dividend paying, go into nice jumps in certain stocks like EVs, for example, where several companies today have performed very well.
On gold, we spoke about this last time as well. Geopolitical tensions really sent it to records, and then it just started coming off. It's almost like suddenly there was no concern about geopolitical issues whatsoever. Is this pullback in gold warranted?
Absolutely. Every pullback in gold is an opportunity to buy, and we will see more pullbacks. Every single pullback is an opportunity to buy. This is our recommendation to our clients. Let's not forget, this whole jump is coming from central banks. In 2022, 2023, there were record amounts of gold bought by central banks around the world. More than 1,000 tons bought in 2022 and slightly less in 2023. This is absolutely massive compared to what we've seen in previous years.
So this is consistent with your view on inflation and the fact that the Fed might be behind the eight ball, if you like. What happens if that part of your thesis is wrong? Is your gold thesis then also wrong?
Well, we will continue buying gold because we think that the East now is buying gold to support their currencies. Sovereign debt has reached very high levels across the world, and the only way for central banks to hedge and protect their currencies is by buying gold. Gold now should be part of any asset allocation in decent amounts.
Ryan, we have to leave it there, but it's always so fascinating to speak with you, particularly post-Fed days. That is Ryan Lamond, Chief Executive Officer and co-founder of Neovision Wealth Management. Thanks for coming in. Still ahead, we get the latest on the Middle East crisis as the US presses Hamas to agree to a ceasefire in Gaza while it nears a historic defence pact with Saudi Arabia. All that next. This is Bloomberg Daybreak Middle East and Africa. Welcome back to Bloomberg Daybreak Middle East and Africa. I'm Vonnie Quinn in Dubai. President Biden is facing a make-or-break moment in talks for a ceasefire in Gaza. Israel and Hamas are the closest they've been to a deal since a week-long pause back in November. Let's bring in Dana Quraish, our Dubai bureau chief. So, Dana, where are we on these talks? It appeared that Israel was waiting for an answer from Hamas, but Hamas has given more or less an answer, no?
So Hamas said, most recently, they said they had given their notes on Israel proposal, but they did not say that they agreed with it or not. And now this is still kind of a back and forth between these notes between Hamas and Israel. Now, the U.S. Secretary of State Blinken has been in the region, still in the region, and what he's trying to do is give these ceasefire talks a big push to come to a deal. And we saw him saying a couple of days back that Israel's proposal was very generous and that Hamas needs to accept it. And this is, of course, not just to relieve tensions in the region, but it's also for the sake of President Biden in the U.S., who is desperately also wants the ceasefire agreement to be finalized. First, to go ahead with a Saudi normalization deal with Israel, and second of all, also to relieve tensions in the U.S., especially on U.S. college campuses.
Dana, how is Hamas calculating this? How is it in their interest now to maybe back off on some demands to allow for a ceasefire? What would it give them?
Hamas believes that it is in a very strong position, and that's merely because they hold these hostages. They can up their demands, but ultimately they want Israel to withdraw completely from the Gaza Strip, and that's, of course, something that Israel won't do immediately. Now, the ceasefire proposal on the table is 6 weeks, and it would start first with the release of hostages and allowing humanitarian aid to go into Gaza. For Hamas, this is okay for now, but ultimately they want, by the end of the 6 weeks, for Israel to withdraw from the Gaza Strip. That, of course, creates security issues for Israel, who is not yet confident that the group had been eliminated completely. And that's, of course, their ultimate goal, given what happened in October 7 and the vow to never allow this to happen again.
Dana Kraish, thank you so much. That is our Dubai Bureau Chief. Much appreciated. We're just getting numbers from Standard Chartered, maintaining its full year 2024 guidance. We have first quarter adjusted pre-tax at $2.13 billion. That's a massive beat. The estimate was for $1.55 billion. So once again, adjusted pre-tax profit of $2.13 billion. And it is also recording a profit, a pre-tax profit of $1.91 billion. That's about $500 million more than the estimate, which was for $1.42 billion. So blowing away numbers here, Standard Chartered. We are waiting to see what kind of capital return plans it comes out with. But at the moment, it's saying that the group remains well capitalized and highly liquid. Don't forget the buyback last time was about $1 billion, and we are anticipating more this time. Shares up 10.9% in the past year. That's about triple the FTSE 100 performance. Once again, Standard Chartered blowing away estimates, coming in with first quarter adjusted pre-tax profit of $1.91 billion, way more than the $1.41 billion estimated. Bloomberg has learned that the US and Saudi Arabia are maintaining and nearing, in fact, an historic deal that could potentially reshape security in the Middle East. Let's get more from Bloomberg senior editor Bill Farries. So, Bill, this was obviously in the pipeline. There was a little bit of a pause placed on it, but it seems now that talks are really progressing. What do we know about what's on the table?
Right. This was a deal that was underway before that October 7th outbreak of war between Israel and Hamas. And that was put on pause, but talks seem to have resumed and are accelerating now, with the hopes that on both sides that maybe they can use, Saudi Arabia and U.S. can use some leverage to help bring about an end to this conflict between Israel and Hamas. Some of the details are still coming out, but we believe it would involve a security guarantee for Saudi Arabia from the U.S. That could include Saudi Arabia getting access to some high-tech weapons that they don't currently have. It would also involve Saudi Arabia getting investments in things like AI and quantum computing from the U.S. and others if they agree to pull Chinese technology from some of their sensitive communication systems. It could also involve Saudi Arabia getting permission for a civilian nuclear program and help setting that up. And that would, in turn, give the U.S. access to some of the uranium reserves that Saudi Arabia has. So from the U.S.-Saudi side, there are a lot of wins, but it also would require Prime Minister Netanyahu, if he wants to have diplomatic recognition with Saudi Arabia, to bring about a quick end to this war in Gaza. And basically, it's a plan that, if carried through all the way, and it could include U.S. Senate approval, it would really reshape the geopolitics of the Middle East.
And could happen very quickly, according to our reporting. Bill, thank you so much for all that context. That's our senior editor there, Bill Farries. Plenty more still ahead. This is Bloomberg Middle East and Africa. Welcome back to Bloomberg Daybreak Middle East and Africa. I'm Bonnie Quinn in Dubai. Apple's second quarter revenue is expected to contract as it faces a continued slowdown in sales. The release will also provide the first official look at sales of the Vision Pro headset. For more, let's bring in Bloomberg Intelligence senior analyst Robert Lee. So, Rob, what should investors look out for in these results?
Sure, OK, if I can rattle through them, probably four main things. The main focus is obviously going to be on the product business and iPhones in particular, given the ongoing concerns and weakness in the China business. So on consensus numbers, people are looking for weak numbers, with revenues potentially down 11% year over year. So that would be a weak number. However, my US colleagues think that could come slightly above expectations, given a mix shift towards high-end iPhones. So that's one thing. Second thing being obviously their service business, which is pretty robust and solid, so it's unlikely that will produce any negative surprises. On obviously, the market always looks forward, so I think the key is going to be guidance. And again, given the ongoing concerns in China and on the iPhone side, there is, it's more likely that will come in on the weaker side. Whether that will be any weaker than the market expects, we'll have to wait and see. And then finally, it's all about shareholder returns as well. Apple is, immensely cash generative. It's sitting on a big net cash pile. Could we see enhanced shareholder returns coming through as well? So I think those are the four main things to focus on.
Rob, when it comes to China, I mean, we've been seeing the data surprise to the upside. Just in recent weeks, it feels like there's sentiment is turning slightly when it comes to China. How long do you think Apple's challenges will persist there?
Yeah, I think Apple is obviously the world's leading premium smartphone maker and was first into the smartphone market. However many years ago that was now, 15 years ago or so. Within China, though, I think the domestic brands have really caught up in terms of performance, and so you look at Huawei or Oppo and some of the other local brands, they really do compete very closely with Apple. And quite often, they offer enhanced features at a cheaper price. So in these cost-conscious times, I think the natural thing is for consumers to look seriously at some of these, really high-end local phones in China. I think the other thing we're beginning to see more signs in China of maybe a push towards buying domestically, tied into this sort of geopolitical backdrop at the moment. So I think that's another trend. So I think the conclusion of all of that is Apple's iPhone sales in China are likely to remain under pressure, unfortunately for them, for some period of time. So there's no immediate end in sight to that.
Robert, thank you so much. Bloomberg Intelligence Senior Analyst Robert Lee. I do want to mention SABIC earnings because we got those, and it's worth repeating that SABIC had a very difficult quarter. That was a 62% drop in terms of profit from the previous quarter, and that's in line with some of the other chemical companies that we've been seeing, like BASF, for example. Shares, obviously, of SABIC, little change this year. The Tadawul itself up about 2.5%, but we'll see how they trade today because that came out after the market was already closed yesterday. Once again, SABIC, the top chemicals company out of Saudi Arabia, talking about weak demand putting the industry under stress and a 62% drop in year-on-year profit. Here's how we're shaping up for today's trading session after a down day across the Middle East yesterday. This is Bloomberg Daybreak Middle East and Africa, our top stories this morning. Asian stocks, particularly Chinese stocks, rallying. This all after Fed Chair Jerome Powell says the data haven't given the FOMC confidence that rate cuts are appropriate, but he also downplayed the prospect of hikes.
I do think it's clear that that policy is restrictive. I think it's unlikely that the next policy rate move will be a hike.
Apple results later are expected to attribute declining sales to weak China demand. The Vision Pro also in focus. Plus, we speak exclusively to the CEO of Qatari telecoms group Ooredoo after first quarter earnings beat. It's just gone 8:30 a.m. across the Emirates. I'm Vonnie Quinn in Dubai, and markets seem to have come through the whole FOMC meeting and news conference pretty unscathed, although it was a little bit of a wild ride yesterday. Stocks gaining after Fed Chair Powell spoke and then declining to finish the session for the S&P, down about 0.3%, for the Nasdaq 100 down about 0.7%. But we are looking at an up day once again today, so maybe a little bit of relief in sight before we get the jobs data. Of course, markets were digesting data out of the US as well, which showed the labour market perhaps a little bit weaker than anticipated, JOLTS data a little weaker, and then prices paid, ISM prices paid, stronger than expected, so inflation stronger than expected. But the Fed chair did seem to put paid to some of those concerns, saying that the Fed is on it, on inflation, and he did leave the door open for an interest rate cut later on this year. So we had the two-year yield down below 4.95, so a few basis points lower. And then Brent crude, we're putting on a few cents there at 84.02, but we're well off that 91 high that we saw in the last couple of months. Let's take a look at this chart because we are looking at the SOX index continuing to decline. So semiconductor outlook, not so great. That could feed through into the economy at some point with weak chip sales. Either way, if you look at the chart, it could indicate that the SOX gap lower may see the S&P following, but that is not a prediction. Let's get to markets in Asia now and that rally that's continuing. Avril Hong is in our Singapore studio. Avril.
Yeah, Vani, we're seeing Asia stocks in Japan and South Korea moving sideways, but that rally underway in Hong Kong. And the Chinese tech names are responsible for a lot of the gain that you're seeing on the MSCI Asia Pacific today, as there's this general optimism towards them as they report earnings in the middle of May, especially after their U.S. tech peers have come through with pretty solid results. Now, the other sector that we're watching, Chinese developers listed in Hong Kong, they're seeing some turn in sentiment, and we heard how Beijing is going to ease some of the home buying restrictions. Bloomberg Intelligence thinks that this could bring on a wave of stimulus for major cities for the real estate sector. Now, let's take a look at what we're seeing in currencies, because after the Fed and how investors had been bracing for a more hawkish central bank, there seems to be some relief in the FX space, particularly for the won, Thai baht, Philippine peso as well. Can't say the same for the Japanese yen, though, testing again once again the 156 level against the greenback, Vonnie.
Avril, we are continuing to monitor. Avril Hong in Singapore. Turning back to the region now, Saudi's economy contracted for a third straight quarter following the decision to cut petroleum production. Meanwhile, non-oil growth eased to the slowest pace since the coronavirus pandemic. Let's bring in Monica Malik, chief economist at Abu Dhabi Commercial Bank. Monica, we were anticipating a bit of a slowdown, but is there any problem with the Saudi economy that we need to worry about?
From the fundamental side, I don't see any problem, and economic fundamentals to me seem very strong. I was a bit surprised by the GDP print, but it is the flash print, and we could see revisions to the data. The headline contraction was expected, and it's worth noting that the contraction was smaller on the headline level as the drag from the oil sector moderated. But as you mentioned, it's really the non-oil slowdown that's of interest. If we look at proxy data for the first quarter of the year, all of those remain strong, and for different parts of the economy. So I think we need to watch out more, but on the fundamental side and indicators of economic momentum, they still look strong to us.
On Vision 2030, it's obviously been cut back, and, we're obviously getting towards 2030 now. But we are also seeing, this balance act between wanting to grow the economy in different ways and having the capacity to do that, and then also allowing for that to sort of take, so labour markets to diversify and so on. What's that progress like at the moment?
It is. I think it's very much now a focus on the fundamentals, on what can be implemented. We've seen such a large pipeline of projects being awarded, announced as well, and it's very clear that not all of these projects can go ahead at this time. I think it's actually quite a healthy move to focus on which areas to really prioritize, the ones that are going to provide the most economic benefits and the growth benefits. I think we have passed the easier part of the growth recovery, both from the pandemic and as the investment momentum started to build. Now you are seeing more capacity constraint, but really it is a longer term investment program. It is a longer term diversification program. And I think that's where the focus is now.
Monica, how much of a difference does it make to Saudi planners that the Fed cuts later this year?
I think it certainly will be a boost. Inflation in Saudi Arabia is significantly lower than that in the US. Monetary policy is tighter than it needs to be. And given the importance of borrowing for the investment program, I think it would be certainly a welcome move. But already at the beginning of the year, we reduced our expectations of rate cuts, and again last month. But we haven't changed our non-oil GDP growth forecast. We do think interest rates will stay higher for longer, and we also see a higher end rate, terminal rate. But I do think for the Saudi economy, they would welcome the beginning of the rate cutting cycle. That said, we do still see the government progressing with its development plans and its investment program.
So when it comes to the Fed, Monica, at ADCB, what are you thinking should be the terminal rate at this point, and when will we get those cuts?
Well, we at the moment can have two rate cuts priced in, one in the third quarter and one in the fourth quarter. However, we see increasing risks that we could only have one rate cut and more towards December of this year, and then 4 rate cuts next year. Again, it's very much an inflation story. We have seen inflation move up. Key areas have seen the reversal of the disinflation trend. And I think the metrics actually for the inflation data will actually deteriorate from July, given the unfavorable base. I think the Fed will really need to see solid signs of the disinflation trend coming back on track. And it could be closer to the end of the year that we start seeing that coming through.
Well, Fed Chair Powell seems certain that will happen, just like yourself. Monica, this move in oil will help too, the geopolitical premium coming out of a barrel of oil. Does that continue? Is it likely that if there is more volatility in the region and there is more volatility on oil prices, that could complicate things?
Well, I think certainly with I know when we spoke last, oil was closer to $90 a barrel, and the fact that we're getting back around the $84 level is very important, and that includes inflation in areas where you've seen currency weakness in emerging markets, Japan, etc. So this is a global area to watch. I think if of course, geopolitical tensions can be volatile. We're hoping at this point for some progress towards a ceasefire, but this is something that we need to keep an eye out on. But also another factor that supported this move down in the oil prices is the pickup in US production in the last month and signs of build in inventories in crude, but also in products at a time when more crude should be going to refineries. So I think that's also a fundamental factor. And oil prices of around 84 shouldn't add too much inflationary concerns, though the drag that we saw in the second half of last year will not be supportive.
Just briefly, Monica, what do you at Abu Dhabi Commercial Bank see as the biggest risk to the economy?
In the GCC, I think at this level, oil prices are very comfortable. I think really what would be concerns would be on the global factor. If there is, for some reason, a sharp global slowdown, that's not our core scenario. Risks of global recession have come down, though pockets of growth are relatively few. I think geopolitics is also something that we're watching closely, but fundamentally in the Gulf, oil prices are comfortable. We continue to see fiscal surpluses for most of the GCC countries, mostly just Saudi and Bahrain where we don't, and we see a focus on diversification programs.
Monica, always a pleasure to chat with you. Thank you so much on this rainy morning for chatting with us. Monica Malik, Chief Economist at Abu Dhabi Commercial Bank. And coming up, we speak to the Ooredoo Group CEO exclusively. That's next. This is Bloomberg. Welcome back to Bloomberg Daybreak Middle East and Africa. I'm Bonnie Quinn in Dubai. Qatari telecoms group Ooredoo posted a big first quarter profit beat, sending shares higher. However, net income came in 5% lower compared to last year. Let's bring in Aziz Al-Uthman Fakhru, CEO of Ooredoo Group. So congratulations, revenue up 4% and profit did beat the two estimates in the Bloomberg survey. But what can you do to goose that profit? Why was it lower than last year?
Oh, thank you for having me. Like, first, I'd like to mention that this is probably the 15th quarter in a row where we improve every single metrics, whether it's top line, profitability, and net profit. Last year was a historical record year for the group, and Q1, as you mentioned, of this year is no exception to this. We've increased our top line by 4%, our EBITDA by 6%, and our profitability to 43%, and our net profit is a normalized net profit is up 26%. We're in the region the most profitable operator with EBITDA margin at 43%. So we're very happy with our performance, and we're continuing on our strategy of very tough discipline in terms of operation and also efficiency on the asset side with our infrastructure play.
Yeah, I want to get to that, particularly the tower unit and the spin-off in a moment. But maybe first tell us what areas are seeing pressure.
We're not seeing any pressure. Actually, all our markets are up. Our customer base is up. We're in line with our guidance. We're actually beating our guidance. We've guided that we will try to reach 43 to 44% EBITDA margin for this year, and we're already in Q1 at 43% EBITDA margin. We're up 1% versus last year. So actually, we are delivering in line with performance. There was on actual profit a few provisions we've took, but apart from that, operationally, we're actually delivering ahead of plan.
Walk us through those spin-off plans for the tower unit. There's obviously a series of tower sales which might close this year and that would release cash. How is that process going?
So exactly last year, we announced the establishment of the largest tower co in the region with Zain, where we merged and contributed all our assets in Qatar, Kuwait, Iraq, Tunisia, and Algeria with their asset of Iraq and Jordan. This creates a vehicle with close to 30,000 towers, an enterprise value of $2.2 billion with zero debt. So that's pretty much equity value. We've signed the transaction last year. We're going through the regulatory approval. We're very confident by this year to close at least two markets. We're looking, of course, to close Qatar first, and normally we should follow with a couple of other markets before the end of the year. So we're very confident with that process.
And the financial impact of the deal, when will that hit and what will you do with the cash?
So these will be subsequent closures. We were looking at a process that should last close to 18 months from now to close all the market. There is an equalization payment, which is roughly of $700 million of proceeds for the Ooredoo Group. Currently, we'd like to close the transaction and get the cash before we think of how to spend it. We've been extremely disciplined over the past year. We've increased our free cash flow by close to 35%. We have a very robust balance sheet, and our net debt is down to 0.9 times net debt to EBITDA. So we have a very strong balance sheet, and we remain extremely disciplined but opportunistic.
Absolutely. You'll have lots of choices. So are there any new or maybe underinvested markets that you're looking at?
So right now, we're especially focusing on our infrastructure play. As you mentioned, there's this tower. We're also carving out our data center businesses. We finished the carve-out in Qatar and Tunisia. Kuwait should be completed by the end of this year. This will establish a data center platform where we've committed to invest up to $1 billion in the coming years in growth CapEx, because we're seeing tremendous growth on that side. On the cloud side, and now with the new anticipation of AI coming, we're seeing even future fuel to growth in that business.
Aziz, can I ask you about Palestine? You're one of the operators in the Gaza Strip. I know it's been very difficult to operate there. Can you give us an update on how your staff is operating there and whether they're even operating?
We're operating where we've been the operator, which remain constantly online in Gaza. The first thing I'd like to do is to salute and commend its staff and the people in Palestine. I have no words to describe their courage, their resilience. They've been managing to keep the networks up in the harshest of conditions. And we have no words, and we're in awe at Ooredoo with their dedication.
And you're able to continue operating both there and the West Bank?
Yes, we're operating both in Gaza and in West Bank. Of course, in Gaza, there are interruptions, but for us to continue to deliver that means of communication to the local population is extremely important. It's actually vital.
Let's move on and talk about Myanmar. You've been trying to exit. That process seems to be undergoing, a little bit of a delay because of regulators and so on. Can you give us an update on what's happening there?
So, yes, Myanmar, we've announced the sale close to nearly 2 years ago now. We are actually extremely confident that we should get to a close within the next few months or weeks, even. I would even say weeks. We're hopeful. Actually, the business on itself has been performing exceptionally well for the last 6 to 7 months. This quarter was up around 16% in terms of top line, but it's a market we decided to exit. We found a buyer, we signed a transaction, and we've been dealing with the regulators. As you know, the political situation there is not of the most stable one, and therefore getting the approval has been quite challenging.
You've been doing really well. You just laid out the numbers for us. It's been another great quarter. What about the rest of the year in terms of comparisons with maybe rivals or competitors like Etisalat, STC, and so on?
We have a different value proposition. Ooredoo had the benefit of having very strong, robust markets such as Qatar, Oman, and Kuwait in the GCC region with low volatility on the currency, but slightly lower growth. But we also have very strong growth engines such as Iraq, Algeria, and Tunisia. Just to recap some number, in Algeria, our top line is up by 16%, in Iraq by 14%. These are tremendous growth engines, highly dense population with a lot of youth and a growing middle class. So we think we have a balanced portfolio and a different value proposition.
All right, Aziz, thank you once again. It's always a pleasure to speak to you after earnings. Aziz Aluthman Fakhro, CEO of Ooredoo Group.
Thank you.
Plenty more still ahead. Do stay with us on Bloomberg Middle East and Africa. Welcome back to Bloomberg Daybreak Middle East and Africa. I'm Bonnie Quinn in Dubai. Turning now to West Africa. The International Monetary Fund has reached a staff-level deal with Mali for about $120 million in emergency financing. For more, let's bring in Bloomberg's Ondiro Oganga in Kigali. So, Ondiro, $120 million doesn't sound like that much, but maybe for Mali it will help. What are the upsides and downsides of this deal?
Vonnie, like you said, it doesn't sound like much, but it is a lot. This funding will go in helping cover food provision costs, providing clean water, and also access to shelter for those who are displaced. And one might be wondering how Mali got into this situation. Their economy has been ravaged by many things, among them COVID-19 pandemic, geopolitical tensions such as Russia's invasion of Ukraine, the disruption of shipping along the Red Sea, and there's also been a regional funding squeeze that made the cost of importing goods such as food and fertilizer skyrocket through the roof. So this is a country that is trying to build back, and the IMF is cautiously optimistic, projecting that they could grow by about 3.8% this year, but next year the economy is expected to expand to about 4.4%. The downside, as you mentioned, this is a country that is still grappling with things like power outage, insecurity, and also financial challenges.
Yeah, for sure. And Ondiro, moving to Kenya, how far is Kenya now from securing IMF funding?
Vonnie, IMF officials are expected to be in Kenya on the 9th of May to continue with a review that is meant to unlock $1 billion in terms of funding. The last time the IMF staff was in Kenya was in February, and they were reviewing the $4.4 billion program that Kenya is currently having under the IMF, and also the impact of Kenya's ability to access the market. And this inflow from the IMF will be very important because there's a Eurobond due in June for Kenya. Kenya needs to clear some of its arrears with their contractors, but most importantly, they missed their revenue target. So this financing is very important. And the IMF projects that Kenya could be at high risk of debt distress. So there's a fiscal consolidation program with IMF to ensure that debt to GDP is brought down to about 3.9% in 2025 and down to 3.3% leading to 2027.
Ondiro, thank you so much. You'll be following this for us as time goes by. That is Bloomberg's Ondiro Oganga. Plus, do tune into our monthly special, Africa Amplified. That's this Friday at 8:30 a.m. Dubai time. Our next episode previews South Africa's critical May elections. Once again, Africa Amplified. That is tomorrow morning, 6:30 a.m. Johannesburg time, 8:30 a.m. in Dubai. Let's take a quick look at how we're shaping up for the Thursday trading session after the FOMC and pre-jobs. We have futures pointed higher across the board except for Europe. So in America, the S&P, NASDAQ and Dow all look to open higher. Euro stocks 50, though, not so much, down about 0.2%. We'll have Tom McKenzie taking you through the early part of the European morning. So do stay tuned to Bloomberg.